Hello and welcome to another episode of the Investing with IBD Podcast. It's Justin Nielsen, your host, and I'm coming to you from the Wilshire Boulevard headquarters here at IBD. We share this with the Wall Street Journal, our sister company, so electrical panel going in, hopefully at my house, so that's why I'm here. Today is November 19th, 2025, and we've got a great show for you. As always, we got John Kosar from Asbury Research joining us again. We just had his son on, Jack Kosar, doing the quantitative stuff as John starts passing the reins on to the next generation. But John, of course, how many years? I don't want to age you, but it's a few decades of experience in the market. A CMT. I should add those special little letters behind your name, and also you spent some time on which was it, the board of options or exchange?
It was a CME. It was over
okay.
at the Deal Exchange.
Yeah, so
yeah.
17 years.
Yeah, that was my college.
Awesome. Well, we're really excited to have you again. One of the things, the first time John and I spoke, one of the things that just kind of really intrigued me about John's stuff is he uses some different indicators and metrics, but a lot of times it really jives with the IBD methodology. So again, it kind of just really takes a look at the market, where that money is flowing, and we'll get into some of the SEAF models and things like that. But the biggest issue lately, and I'm going to pull up a chart here as we talk about it, John, but the biggest issue lately is we had this really nice trending market since April, and lately it seems like what we've gotten is just chop. And I'll be honest, I have not been handling this well myself. It seems like I've tried a new strategy where I buy at the highs and sell at the lows, and that just doesn't seem to work as well. So I'm going to try and shift that and go back to the other way. But talk to us a little bit about your blinking indicators, because I think it's very interesting when you're getting signals that turn on and off, and it just kind of shows how tricky this market has been.
Yeah, you often see that at the turns when the market isn't quite, it's kind of in between trends, so to speak. That comes from the Asbury 6, and the Asbury 6 is our daily indication of what the health of the market is. We back tested, 25 or 30 different tactical tools that I've used throughout my long career that I've had success with, and I understood the indicators well, and maybe I used them when I was in the pit. And we started to back test them in various sets of 4, sets of 5, sets of 2. We ended up with 6 that worked really well together. And there it is, in the respect that what I was looking for is just what you said. The markets are noisy now. They're noisier than they were 10 years ago. You have a lot of days. Just watching today, the market was going between 30 higher and 30 lower. It must have went back and forth 6 or 7 times. A couple of weeks ago, we had some wild days like that. We were up 80 and then we were down 40. So I wanted to not get faked out by all the noise that I was seeing on the intraday. So we found 6 indicators that back tested really well together, in the sense that if 1 or 2 of those indicators, and no indicator works all the time. I've never found one. If anybody knows, you can let me know.
Put those in the YouTube comments, folks. We'd love to hear the 100% guarantee.
Yes, we're still looking for the Holy Grail. Doesn't exist. So we found 6 that work really well, where if 1 or 2 aren't working in that certain environment the market's in, the other 4 would pick it up. That's what the Asbury 6 is. We look at it as kind of an EKG for the market that we update every day. Right now, all of them are red, which means they're negative. And notice the dates, they're all on 11/13. So that's when we flip. Now the blinking part is what's been going on for the past month, is you're getting a lot of quick moves from 4 or more green, which would be a bullish reading in the A6, to 4 or more red. When it goes back and forth like that, it means that those metrics are all at their balancing points, which tells us either the trend has to resume from there or it's going to roll over. And right now, so far from what we can see, it's starting to roll over.
Right. And so just so we can go back to the chart and folks can see where that 1113 um, blanket blanket switch to negative, that was this day right here, where after getting back above the 21-day moving average line, we tightened up for a little bit on the NASDAQ and then went right back below that 21-day moving average line. So same thing happened basically on SPY. It had a little bit of more progress instead of just holding tight, but on the 13th, it started coming down. And one of the tricky parts here, again, you're a charter market technician. Upside reversals. I mean, I love seeing those. But man, we keep on getting all these upside reversals that get undercut, and then it seems like it's another upside reversal. So every time you get excited and you're like, oh, I can limit my risk here, it does just enough to shake you out, it seems like, but then it's not enough to really firmly establish a downtrend. And I think that's where it's the trickiest, because when it's a downtrend, I have no problem staying out. That's easy. When it's an uptrend, I have no problem staying in. But it's when you kind of just get shaken out and then you kind of reverse, and that means a lot of, I don't know, chop, right?
That's where the A6 came from. I mean, I had been doing this this is year 43 for me, believe it or not. But, the last 10 years have been really a lot harder to stay in a trend, just what you talked about. Character of the market's changed. It's a lot more volatile intraday, almost to the point for us where the S&P during the day has been the noise and the A6 has become the signal for us. Because we're finding out by using those kind of metrics, we're not getting shaken out by a bad day where the market ends down 60 or 70, and then we're buying fresh highs 3 days later. That can put you out of business really quick. So that's why we use that tool. We want to be focused on not the intraday gyrations of the S&P 500, but we want to see what's going on kind of underneath the hood. I know I'm using a lot of metaphors. But that's really what this is for, is to keep me, a guy that's been doing this all my life, from getting faked out by one of these moves.
Now, one of the metrics of the Asbury 6 is the volatility, and here's the CBOE volatility index, 0 VIX on market search charts, also known as the VIX or the fear index. And I mean, of course, it's no big surprise that on October 10th, as this brawl kind of started happening between rare earths, tariffs, China, U.S., a big spike in the VIX. But surprisingly, we've come up quite a bit in terms of the VIX, in addition to that October 10th kind of disaster. I mean, you mentioned kind of an intraday volatility, but you're certainly seeing an increase in the implied volatility of the options market, which is again what the volatility index measures. What does this being this high kind of tell you?
Well, it's not really high enough to indicate any kind of a buying opportunity like we had in April. That's right in the middle of the chart. You can see where he had that huge spike up there. But notice how just the general trend, there's a lot, it looks like there's multiple moving average that are drawn in there. I can't discern.
Let me take some of those off. That is a little noisy.
That's what I was going to talk up to. There was a nice kind of a downtrend there. And then really, as of the middle of October, that's when you saw all the VIX started running up and down through those averages. And that's the chop. Really, that's when the A6 started to blink back and forth between red and going to green. And you could see it in the VIX there. So 21 days for us is our tactical time period. So when the VIX is above the 21-day moving average, that suggests to us that the market is starting to become a little fearful, and that's one of the Asbury 6. You can see it's been there for the past 4 days, but it's been pretty choppy since the middle of October. So that chop that you see in the VIX, the chop that you see in the S&P, it shows up in our Asbury 6, but our Asbury 6 is 6 different indicators. So it kind of it's kind of a baffle, so to speak. It takes some of that volatility out because we're looking at different things there. We're looking at breadth and relative performance, and it kind of calms the chart down for us. Let's say that.
Hmm. Well, speaking of calming things down, one of the other, I guess, market indicators that you use or models is your CPM, your correction protection model, if I remember that correctly.
Right.
So maybe talk a little bit about that, because that does tend to be a little bit more. Let's stay in for the trend and make sure we're out when it turns. What is your correction protection model telling you?
That, well, the difference, the A6 again, is meant to be an EKG for the market every day. I want to see every little bump. I
Hmm.
want to see every little wiggle. The CPM is a model that we actually trade. I traded it for my own account. We traded for our clients. We're managing money now, and we've built some model portfolios that have CPM as one of the components. The CPM is built to keep you in the market as long as possible because the market inherently goes up. When I got off the trading floor and I wasn't trading bonds or Forex or some of the commodity markets anymore, initially the stock market was easier for me because it generally goes up most of the time. So your strategy is a little bit different. So we built the model to keep us in. So CPM actually went to risk off, and doesn't do that very often, on November the 17th. Prior to that, it initially went back to risk on April the 24th, and then it had a short period that it was out of the market after the October 10th wild day that we had that had the huge range. And I
Hmm.
think we got right back in on the 21st of October, but we are now risk off, which means that we are pulling back our equity exposure for our
Hmm.
accounts.
Yeah, so I'm marking here as the April 24th day that you mentioned. Within days, and I find this happens all the time with our stuff, John, where we're within days of each other. Here was our first signal to follow through day, but really that April 24th was the day that it was time to kind of, oh yes, this is working. As you mentioned, the October 10th. That was nastiness right there. A lot of sideways action, and then you mentioned that the 17th, which was just a couple days ago, right there as we broke below the 50-day moving average line, and that was the first close below the 50-day moving average line, basically since April. So yeah.
Is May
um,
1st. Actually, first went above the in the S&P.
yes.
First day was May 1st, up above the 50.
Hmm. Up above the 50, right? Yeah. So we got above the 21-day moving average line a little bit earlier, but above the 50, yeah, shortly thereafter.
Mhm.
Um, so okay, so we've got kind of some some negativity out there now. I'd be remiss if I didn't acknowledge the fact that Nvidia earnings have come out, and
Mhm.
right now it looks like Nvidia is up 6%. I was looking just briefly before we started, and I can't remember what the words were that Jensen Huang used, but basically how Blackwell sales were through the roof or something to that effect. And yeah, so we already were seeing again another few upside reversals here in Nvidia, and even today was not a bad day, up 2.85%, adding to that. Now, that doesn't mean that's going to happen tomorrow, right? A lot can happen between now and then, as you well know, and it's not necessarily that I want to focus on Nvidia, but I guess since for a while there it seemed like as Nvidia went, so went the market. Um, does that kind of introduce another potential blink, blink for you to the positive?
We try not to we try not to game our own indicators.
Hmm.
So we're not going to change our um, the metrics we use, our own metrics, the CPM, the Asbury 6. They're not going to change because of one stock. I mean, even if it is Nvidia, um, it's a group that measure different aspects of the market. So yeah, it's interesting. And like you said, what looks like a really good report here, by the time we get to tomorrow morning, a whole lot of stuff can happen. So yeah, I try not to read. I watch them with interest. It's fun to watch them,
Hmm.
But one report like this, even if it is an Nvidia, it doesn't affect our models. We want the more broad metrics that are in the models to tell us what to do.
Hmm. And as we kind of drill down a little bit, Nvidia, of course, is one of the biggest members or biggest weights of not only the Qs and the Nasdaq Composite, but also of SPY, also of XLK. So I mean, it's just SMH. You take your pick. It's a big member of a lot of different things, but I want to kind of look at some of the other charts that you're sharing with us, just in terms of the overall market. And this is the Nasdaq versus the Qs. And we were talking before the show started about how you do a lot of things where you do these charts one on top of the other, so you can kind of see, okay, here's what's happening with the index, and here's what's happening with, in this case, the Q's total assets. So you have this yellow shaded. I take it something important here happened.
Yeah. Here's what we're showing here is this is the daily AUM of the QQQ, which we know tracks the NDX, the NASDAQ 100, since April. And what it's showing is those assets started expanding on a 21-day basis. Again, that's our tactical time period. And it tested that trend 4 times on June 20, August 1, September 2nd, and October the 10th. You could see a couple of them went through the line for a day or two or three, but money came in, and all 4 of those turned out to be nice short-term bottoms in the NDX if you follow the green lines up to the top deck there. What's happening now is we're spending more time underneath there and to a larger degree than we were the previous 4 times. That doesn't mean that this can't turn on a dime and be back up above the 21-day. Nobody knows what's going to happen. Forecasting is a euphemism for guessing. I mean, nobody knows.
Yeah.
But the way this looks right now is that we're starting to bleed assets out of the Qs. The Qs are where the Max 7 is. The Qs have been where the driving force has been through a lot of the rally this year. So that means a lot to me. It's not, again, there's no one indicator, but if we look at 100 tools and 60 of them are giving us the same answer, it gives us a
Right.
lot more confidence.
Now, as we look to another one of your models, this is what you call the SEAF model, sector ETF asset flows. It's not that that's all doom and gloom. There seem to be some green shoots in some areas, specifically healthcare and energy. So talk to us a little bit about what this model is telling you in terms of a little bit more where the money is going to in the latest few cycles.
Yeah, the CPM we built to be a replacement for that standard 60/40 portfolio because it really doesn't work anymore. This was built to replace that part of your portfolio that always stays in the market.
Hmm.
Most people we work with, you don't go to cash. There's a portion of your money. If you're a manager, it might be different than if you're an individual. Most people don't like to go to cash. So what this does is Jack and I built the first version of this, got to be close to 8 years ago. What it does is it quantitatively measures the velocity of money moving around the 11 sector spiders, which you see there, which together are the S&P 500. And then we rank them in 3 different time frames: trading, tactical, and strategic. And then we list them for our score. So what you can see, healthcare here, the fastest money the money is moving fastest into XLV in all 3 time frames. That's why we have a score of 3 here at the end, and that's the best score that you can get. The worst score that you could get would be a 33, and that would mean you would have 11s all the way across the bottom. Across the bottom you have XLC, and we got a score of 29, and that's an avoid for us. So yeah, that's telling us right now the fastest money going into multiple time periods right now in order is healthcare and XLE, which is energy.
Hmm. Yeah. Now, what about again, because you're looking at different time frames? Um, how how much weight do you give in terms of how low does it go before you say, oh, I really have to kind of think very long and hard about if I want to keep my money there?
We did a back test. We did extensive back testing on this. Actually, we knew that the premise of the model worked. It was very obvious to us that those asset flows, they're not everything, right? There's interest rates and there's news coming out of Washington and geopolitics and a million other things. But the asset flows are a very important aspect of what makes an ETF go up or down. So the back test showed us that we got the best performance, and this is another building block of some of the model portfolios that we use to manage money, was the top three. So we're always invested in the top three. If the top three changes and the model is rebalanced once a week on the weekend, we usually have it posted on the website by about midday on Saturday. Let's say hypothetically financials falls and it's now number 4 and XLI goes up to number 3. Following Monday morning on the open, we will exit XLF and we will allocate that money back into XLI, and now we're set for the week. So it's always the top 3, and we let the asset flows weed out the ones that are weaker and tell us where the strength is.
Mm-hmm. And when you get kind of, I feel like sometimes when you get the blinking signals for the market, sometimes that can bleed over into your sector rotation. So it's almost like you're getting false starts, where it goes and then it's back off. And I'm sure some of that shows up more on the trading the week and the tactical the month. But is there a point in which it's like moving too much, too indecisive that you start ignoring things, or how do you handle that when you get a lot of that back and forth?
We don't move in and out of the models depending if they're working or not. I mean,
Yeah.
these are all back tested for 7 years, and we know Sharpe ratios and maximum drawdowns and up and down capture and all of the Greek, so to speak, all of the different ways to slice and dice to see if your model's working. We actually haven't noticed any connection between a blinking Asbury 6 and what's going on over here. What we've noticed going on in the SEAF model, we've seen a lot of that more than normal this year. And remember, this is a relative performance model. So all we're trying to do is be in the right places. Even if the market's going down, we want to be in the places where the market's going down the least. But this year we've had the tariffs. The tariffs are on, the tariffs are off.
Right.
Then we had the interest rates. Are we raising rates? Are we lowering rates? Are we going to have an independent Fed next year? Geopolitical relationships. There's been so much. The market can handle bad news very well. It can't handle uncertainty, and we've had a lot of uncertainty this year. So what we've seen is a lot of rapid rotation at the top, and we've seen odd top threes. Like we might have a top 3. We've seen this a lot, where you'll have XLP and XLK both in the top 3.
Right.
And
Or
to
especially
me,
lately, or for a lot of this rally, it was XLU, right? A lot of the
yeah,
AI adjacent, so XLU normally defensive, and all of a sudden there it is right up there with XLK, the technology.
XLQ has changed kind of who it is or what it
Yeah.
is, right? Because of the energy demands from AI. But if you see XLP up there and XLK, that's very, very anecdotally, staring at this thing for a lot of years, that doesn't happen very often. But when it does, it means managers aren't quite sure of if they should be offensive or defensive, or you have a split with managers. Some are offensive and some are putting on the brakes. So you get this crazy rotation at the top, and that's what we've seen.
Yeah. And I just want to reiterate something that you said, John, because I think it was very important. I'm throwing out the question, and you kind of swatted it to the ground in terms of, yeah, we're not gonna change what we do because we've got like a special feeling this time. You have the model, you've back tested it, you know it's not going to be 100%, but you know that over time it's going to work out. So yeah, trying to go for a feeling, or, oh, I don't think it's going to work this time, is just not the game you play.
Well, that's from being on the trading floor for a lot of years and getting monetarily beaten up
Right.
trying to um, be a seat of the pants guy. I
Yeah.
never was. I'm a lot more comfortable with math and with back testing. The past can't tell you what the future is going to be, but it can give you an idea of what to expect. And that's kind of what we believe in.
No, absolutely. And I just want to kind of switch over to not just the SEAF model itself, but to kind of narrow this down. So let's talk a little bit about applying the model. And as you mentioned, you call this your rainbow chart. XLV, the healthcare, that's right up there, right? It's in that top three, and you can see how it was there earlier this year, all the way back before we got into all this tariff trouble, and now here it is coming back. So what is this kind of telling you?
So Jack and I are sitting in the office a couple of years ago and saying, man, would it be cool to be able to show how well the SEAF model works visually? You can. So what this shows is the SEAF scores for healthcare. This is going back 1 year. So this shows that most recently, on October the 2nd, it moved back into favored status. It stayed there since. Since October the 29th, it's outperformed by 7%. And then if you look further down, this is between, we follow this every day, so I kind of know this like the back of my hand, but healthcare was kind of the whipping boy in the sector space for a long time. It was right down in the bottom. And you can see here from basically May through August, the middle of August, it was buried in a void. It kept getting up to the neutral area and falling back down, but staying in the red. Look at all this relative outperformance. So if you're a manager, sometimes knowing what not to buy is just as important as knowing what to buy. So, we work with a lot of money managers too, and what they might be doing here is looking at their portfolio and maybe avoiding healthcare here and starting to put healthcare on after it moved in the favor. You can see here earlier in the year, in February, we were in favored for, 6-8 weeks. We had a nice little pop here. So all this is doing is it's showing, according to the algorithm that we built, where the aggressive movement of money is taking place within the 11 sector spiders. And this is just a graphic representation of that.
Yeah, no, very, very powerful to kind of just, again, show how things move. And again, if you look at all of the different graphs, you kind of see, okay, this is what the up and comers are, and these are the ones that just can't seem to make the move, as you noted with XLV earlier this year in May to August. Taking kind of a broader step back, I guess one of the concerns, especially of the last few years, has been how much of the index power has been due to the Magnificent Seven, the FANG stocks, your mega caps, your $1 trillion club, whatever you want to call them. When you're looking at, again, these comparisons, especially relative performance of SPY versus different things, what does the concentration in those mega caps and what it's been doing to the indexes, does that give you any hesitation, especially when you look at something like the equal weighted RSP, versus SPY, and how poor that's been over the last few years? What does that tell you? What does it mean to you?
Well, we just built this simply. We started to watch this, I should say, during the summer. Once it was pretty apparent that this was a Mag 7 driven rally, and you can't turn on CNBC and
Right.
put a clock on it, and someone's going to say Mag 7. It's like a drinking game, right? Yeah. It's just clear that that's been where the strength was. So we just watch this, and we look at it in different time periods. I showed you the 63-day moving average here again, because that's the strategic time period for Asbury. And I want to know when that trend changes. And it's getting tested now, which is why we're looking at it today. It's been in effect. And that's how we do our models. Um, Tactical is 21 days, strategic is 63. So this is important to me now, especially now that we know that the Asbury 6 has turned red, CPM is off. We've broken the 50-day moving average, by the way, I think in every major US index. Well,
Right.
both of the NASDAQs, the SOX, IWM, the Dow 30. So now I want to see when this starts to give up its quarterly leadership. That's going to be important to me. That's going to be kind of another chip on the scale of, we're going to go into a correction now.
Hmm. Yeah. So at this point, I guess, this is just telling you that right now the Magnificent Seven isn't doing nearly as well as the other 493. At least lately has taken a bigger hit. And even that's not equal, right? You've got things like Meta that are probably dragging this down a little bit more. Things like Google, I mean that, or Alphabet, I should say, that are helping things, not be as bad as it could be. And speaking of relative performance, another, I guess, when you're looking at the consumer staples versus the consumer discretionary, XLY, of course, being the consumer discretionary, Amazon and Tesla, two the two largest components for that one. XLP is your staples. You've got things like Walmart, Coca-Cola, and what is this? I mean, this looks pretty sharp in terms of this relative performance drop. What is this telling you?
Yeah, we're big advocates of using relative performance to tell us what the market's thinking, or better said, what the market's betting on with its wallet. So this is consumer discretionary XLY versus staples XLP, daily relative performance in the lower panel since the beginning of the year. And you can see from February 10th to May 8th, XLY was underperforming XLP, or staples was outperforming discretionary, which is a defensive stance for the market.
Hmm.
It caught that move pretty well in the S&P 500 upstairs in the upper panel. And now you see the inverse from May the 9th to November the 13th. You could see we came down and tested it a little bit there in August and September. And those are two nice little bottoms in the S&P 500 if you just kind of vertically look up to the S&P 500. Well, now we're through it. We're through it since November the 14th. That tells me that the character of the market is shifting again towards a defensive one like it was in February and May. Is it going to stick? I don't know. Can you tell me the day that it's going to end? I wish I could. But for right now, it's telling me that the market from this lens is starting to act like a market that is going into a defensive stance.
Yeah, absolutely. Well, let's kind of we started broad with the market. We kind of got a little bit narrow with the SEAF. Let's get a little bit more narrow in terms of just beyond the sector spider. There's 11 of those. Let's go into some of the other ways in which you will take a look at specific ETFs. And we can start with IBB, which is the biotech. So within XLV, the healthcare area, one of the areas that has certainly been among the strongest is XBI, IBB. Take your pick. But how do you kind of judge the strength here on the more granular level?
So we have multiple ways of determining what to buy and what to overweight. This is a different model that we use to identify which ETFs we should be buying. So basically in the morning, Jack does a scan of 65 or 6,600 ETFs, looking for our own criteria regarding trend, regarding relative performance, and regarding AUM in that particular ETF.
Mm-hmm.
Once it meets those requirements, it's got to be in an uptrend according to the criteria that we've set for this scan. It's got to be outperforming its peers, and assets have to be expanding, indicating that we're not the only guys that think it's a good idea, right? We're seeing some money going in there, and the money's expanding, the AUM is expanding. Once we go through those three, I look at those. So we take a list of 6,600. I may get 15 of them to look at in the morning. Then I look at them and I use my experience to tell me where the risk reward is. Like, we're not going to buy something that's underneath an old high. We're not going to buy something that's up against the trend line. We're going to try to buy ETFs where we can buy off a support level. We could buy a new breakout, kind of blocking and tackling, really in terms of technical analysis. But I find those where I can have a small risk. We don't risk any more than 5% at any idea. And we're looking to make triple that or more. And so those criteria were met for IBB on 10/16. So we bought IBB on 10/16, so about a month old now.
Okay, I'm going to go ahead and go right there. So
Yeah, so we're up
okay.
9% so far outright. And what I like even more is we've outperformed the S&P by 8%, during
Mm-hmm.
that same period. And we adjust the stops as we go. We have some technical tools, kind of hybrid technical tools that we've made that tell us when to get out. These are trades rather than investments. Our average winner, I think, is 5.4%. Our average loser is 2.4%. 54% of them have made money. So that's what we're looking to do, and we do it over and over and over again. In fact, we have some options traders because we know that our average winning trade lasts 18 days, 18 business days, which is 3 days short of a business month. And they're 5.4% on average. Somebody that's an options trader could buy a call on those when all the time premium is almost gone, which is all the expense of an option. And they could buy they could buy a call for ABC that has 30 days till expiration and is 5% out of the money. You can get those generally pretty cheap. So in other words, we can use the information that we found, what kind of performance we're getting out of this approach, and you can apply it to the options market too. So that's how we come up with those ideas.
And so you mentioned the 18 days, so we kind of have a sense of your time period. But because Jack's looking at kind of this large universe, I would imagine you get a lot of overlap. So for instance, IBB, XBI, there could be a lot of
Yes.
ones that, they're maybe a little bit too similar. So how do you decide which one to go for?
That's the only subjective part of this for me, as I'll look at those. Right now, energy is starting to bubble up to the top. I'm
Mm-hmm.
getting 6 or 7 of the XOPs and the OIHs, and those type of ETFs. So what I'll do is I'll look at them and see which of those do I have a place to lean on a long position. Is there a trend line I could lean on? Did we just break a trend line? Was there a chart pattern that we broke out of? Is there some other technical, again, kind of blocking and tackling technical analysis? Is there some tool there that I can use to lean on? And I will choose that one because that gives me the best reward. Risk reward. I generally won't buy an ETF if it's right in the middle of the chart and there isn't a moving average that it just went through or something that I can use so I can hang a stop there. So that was a great question, but that's how I do that because you don't know which one's going to work. You
Yeah.
don't know if they're all going to work. So what I try to do is find the one, and usually what I'll do is I'll test them. I might have 5 of them. So I'll test all 5 of them and see what the Pearson coefficient, just a simple linear
Yeah.
correlation, make sure they're all the same animal. And once I do, then I just kind of subjectively choose the one that I think has the best risk reward.
Do you have a preference? Because some ETFs, the way that they're weighted is very differently, right? You have like an XBI that's a lot more evenly weighted, a lot of 2% positions, as opposed to an IBB that has 10%. So sometimes when you're looking at the holdings, you can kind of get a sense of that if you look at, how much weight is the top 10 holdings? Is it closer to over 50%, meaning it's a lot more concentrated, or is it more like 10%, meaning it's very spread out? Do you have any preference in that regard?
No, I
Okay.
don't.
Yeah. Simple. Okay, let's talk. Let's talk about another area in which that you're watching. This is the commodity space. So certainly we've been following gold quite closely, but what else is in this ETF, the commodity?
The commodity space is not one that we normally get involved with. Um, I'm looking for stuff to buy that is not equities because of what we see unfolding in the equity market. I want to make sure if the equity market, if the S&P drops and is down for the next 2 months and we're down 15%, I want to make sure I've got ideas for my clients. So we're looking, kind of turning over rocks to see if
Hmm.
we can find um, places for them to put their money, whether it's international stocks or something that's outside of the equity, equity realm.
Hmm.
So what I've been noticing, a lot of the agricultural stocks, or ETFs rather, have been starting to show up on our morning scan. So soybeans, SOYB, is one that we're looking at. Keep this up because
Oh,
that's
okay.
another one. That is DJP. It's the IPF Dow Jones UBS. It's got like a paragraph for a name. UB
Right.
Commodity Index, ETN.
Uh-huh.
Um, but this is the same. Um, this is the same kind of scenario. Trend. It's actually outperforming the S&P 500,
Uh-huh.
which I love. And it's had some good asset flows. Took a look at it. Sometimes I'll look at one of these and it'll have the trend, relative performance, and asset flow part, but it won't have the risk reward part. So it
Hmm.
goes on a list and we look at it every day. IBB was just like that. IBB was up against the resistance level from an old high, and I watched that thing for a couple of weeks. I felt like I was hatching an egg. But I was watching it for a couple of weeks and it finally broke through that level, and we kept the trend, we kept the relative performance, we kept the AUM, and I bought it then.
Hmm.
Because what I tell people all the time, I don't care how much you love it, you don't buy it up against a resistance level because your risk reward is upside down. And that's a really important part. Sometimes you have a good idea, a great idea, but you get knocked out of it, and then it goes and rallies 15% and you feel terrible. A way to alleviate that is to make sure you know where these obvious levels are and you're patient enough to wait till risk reward is on your side.
Hmm. Yeah, that totally makes sense. And uh, just to kind of wrap a bow on DJP, as I mentioned, gold is definitely one of the big spots here. Copper, silver, but it also has oil. Whether it's the Brent crude, natural gas, corn, and you brought up soybeans. So maybe we can end on this. This is the soybean fund, and certainly as the negotiations were going on with China, back and forth, we saw, a big kind of, here's the October 10th, a big drop there. But as things look like they were getting worked out, this has really soared. So I guess maybe a little bit more newsy lately. So how does that kind of put it, come into your equation when something is getting tossed around a lot by news, as soybeans have?
Yeah, we try not to let, excuse me, we try not to let what's going on in the news affect what we buy. We rely on our models and we rely on our strategies, which are, they're kind of like our bedrocks. So we take all the emotion out of it, we take all the chatter out of it, and that's the only way. It's kind of like, and I'm not a golfer, but my dad was, and you swing the club the same way all the time. And the way you do that is by following strategies strictly, back testing them, knowing how they perform under adverse conditions. What I love about the soybean one is let's say we go into a correction and we're able to be risk off, and the S&P drops 15%, and we help our clients to avoid that. That's great. But what's really great is while the S&P is going down, if you can give them something else to redirect to that's not in equities, and they can make a few bucks while they're waiting for the sun to come back out in the equity market, that's kind of checking all the boxes for me. So I love doing stuff like this, especially when the stock market looks vulnerable. I try extra hard to find non-equity ideas that we can move into in the event that we do get a correction in the stock market. We can still make some money while we're waiting for the stock market to start going back up again.
Yeah, no, that totally makes sense. Well, John, I really want to thank you for coming on again. I just, again, am fascinated by your models. It's great that you get to work with your son, Jack. And I want to make sure that people know where to find you at asburyresearch.com. That's where you give a lot of this information. So folks that sign up there can get a lot of great stuff there. Any final thoughts before we go, John?
No, the only other thing I was going to mention is Jack's idea. We started a YouTube channel about.
Okay.
He's dragging me into the 21st century.
Uh-huh.
So we have a YouTube channel. There's a lot of videos on there, and so if you like our approach and you want to learn more about how we do things, how we look at markets, it's Asbury Research, of course. It's on YouTube, and thanks, you guys. I always love coming on your show. It's a lot of fun. I appreciate it.
No, it's great having you, John. And again, thanks again for again your approach. Very just rules based, which I love. And again, as you said, you've got the back test to kind of give you that confidence, even when it's maybe not going your way temporarily. You kind of can do the long term. So really appreciate it. And we'll see you next time, John.
You bet.
That's going to wrap it up for us this week. Thank you so much for watching, and don't forget to come back next week. We're going to be on at a different time, given the Thanksgiving holiday. We know that a lot of people want to get out of Dodge on Wednesday, so we're going to have our live event on Tuesday, same time, 5 p.m., live at 5 p.m. Eastern. And we're going to be joined by Jason Shapiro again. He, of course, is the founder of Crowded Market Report. And, he looks at all these futures. He gets the data, and he wants to be on the other side of that trade, and talks about the news failure events and everything like that. So it'll be real interesting to talk to him to kind of see where he's positioning himself, since he's such a contrarian. So we are looking forward to talking to him again. Hope you join us for that. That's going to wrap it up for us. Thanks so much for watching. We'll see you next time.